For this mock exercise, we're going to take a look at reporting and analyzing long-lived asset with a company called Chin Corporation. And in this question, they were given 3 scenarios. And so I'm not going to write anything. I'm just going to explain the answer to these 3 scenarios. So let's first read the required of the instruction. It says, explain whether or not the accounting treatment in each of the above 3 scenarios follow generally accepted accounting principles. So really we're asking the why. We're asking to explain whether what the co-op student did was correct or not, or whether it was compliant with the accounting, generally accepted accounting principles, GAAP. If an accounting principle or assumptions have been violated, explain why. Why is it, and why, and what is the appropriate treatment? So that's essentially what this question is all about. So why don't we focus on each one of these scenarios? So let's look at the first one. Okay. So Tony learned that Chin is depreciating its building and equipment, but not its land. She could not understand why land was omitted, so she prepared a journal entries to depreciate all company's property, plant, and equipment for the current year. So what did Tony do is Tony realized that land was not depreciated. So she turned around and depreciated the land. So to answer that question, we need to understand what depreciation, why do companies depreciate their asset? Well, depreciation is defined as a way or a process of allocating the cost of this particular asset to an expense. And it's a way for us to allocate to an expense over its useful life. And the idea behind there is we need to reflect the associated cost of using that asset. And using that asset is going to help us generate revenue or generate some sort of benefit to help us generate revenue. So we need to reflect the associated cost of that. And that's what depreciation is. So it's reasonable to have both building and equipment because the consumption of that building equipment will help us generate that future economic benefit. And of course, the consumption of that land and the building and equipment will the economic benefit or usefulness will decline over time. As the asset gets older, it's no longer as useful. And that's what we're trying to show. We're trying to show the usefulness of it. And we're trying to make sure that the asset gets depreciated over the useful period. Now, land in general does not decline with time as we use the land. So land is one of those finite resources. As we consume, as we use the land, it doesn't normally decline its usefulness. And that's the reason why we don't depreciate land. Land does not decline over time, does not decline its usefulness or economic benefit. And oftentimes the usefulness of land is indefinite because of its finite nature. So therefore, it would be incorrect for the co-op student to depreciate the land. Okay, so that's the answer for the first part. Let's look at the second part. Tony determined that Chin's amortization policy of intangible assets was wrong. The company was amortizing its patent, but not its goodwill. She fixed that for the current year by adding goodwill to her adjusting entry for amortization. So what did Tony do? She decided to amortize goodwill. She told a fellow student that she felt she has improved the consistency of the company's accounting policy by making these changes. So what she's done is she's saying, because all intangible assets were amortized, and given the fact that goodwill is an intangible asset, for consistent purposes, we should be amortizing that asset as well. Now, goodwill is one of those intangible assets with an indefinite life. Well, first of all, it's difficult to measure the benefit of goodwill because goodwill is supposed to be something that the company has that provides them an edge in business or provides them, a certain future economic benefit through streams of revenue for the business. And according to our standards, goodwill is not amortized, but are specifically reviewed for impairment annually. So there's an annual process whereby you have to test goodwill, whether the goodwill asset has been impaired. And that testing happens annually, not necessarily at year end, but it could be any period close to year end, but the testing has to be the same date or same period every year. It doesn't necessarily have to be year end. And the testing is quite involved, but the key to remember is the testing requires us to compare the goodwill carrying value to its recoverable amount. And if the recoverable amount is lower than the carrying value, then we consider that to be a decline in value, and therefore the difference between recoverable amount and carrying amount is the amount that we need to write down the goodwill, and that is considered what we call the impairment loss. And that impairment loss is reflected in statement of earnings or the profit and loss statement as an expense. So the amortization entry that Tony did to be consistent for goodwill should be reversed, and no decline in value should be recorded until the impairment in value occurs. So Tony needs to test the impairment of goodwill and to test it every year, and that's the only time you would actually write down goodwill. Now let's look at the situation number 3. Chin Chin has a building still in use that has 0 carrying value. So basically it's fully amortized. So they have cost, they have a cumulative amortization equal to each other. The carrying value is 0, but has a substantial fair value. And that's fairly true actually for a lot of companies, well-established companies that bought land and building or perhaps equipment many, many years ago, and now they've fully amortized the asset, but they're still currently using the asset. Tony felt that this practice did not benefit the company's user, especially the bank, and wrote the building up to its fair value. So what Tony has done is she's saying that given the fact that the building has a substantially higher fair value, it would make sense to write up the a building to fair value as opposed to leaving it at carrying value, which is 0. And that's going to help the bank, particularly the user called the bank. After all, she reasoned, you can write down the asset if fair values are lower. Writing them up if fair value is higher is yet another example of improved consistency that her employment has brought to the company's accounting practice. So first of all, the concept that Tony wants to use is what they call the revaluation model, and the revaluation model is only permitted if the company uses IFRS standard. And revaluation model is used only on subsequent measurement of a category of property, plant, and equipment. So there is a flexibility for companies if they're using IFRS to perhaps use the revaluation model, which allows support for what Tony has done, was recording the building, which has 0 carrying value, to a fair value basis. But to qualify for the revaluation model, the fair value of the building must be reliably measurable. So that's one of the criteria. If your company wants to apply the revaluation model, the fair value must be easily determined and must be reliably measurable. The revaluation model must be done on an ongoing basis. In other words, you can't just do 1 year and then forget about it. And the entire category of buildings. So it's not just one building that Chin Chin owns. Maybe there are multiple buildings, but it's only the one building that has a zero carrying value that Tony wants to write up. So the revaluation model requires that the entire category of buildings must be revalued at fair value. So there is support for what Tony has done, but there are several conditions. Now, if Chin Chin uses the accounting standards for private enterprise, in other words, these would be the private enterprise accounting standards, revaluation model is not permitted. So therefore, an upward revaluation of property, plant, and equipment is not allowed under the accounting standards for private enterprise. It's only really available if Chin Chin was using IFRS. Thank you.